Good evening, everyone. I'm hoping that each and every one of you are keeping in good shape, all busy in continuous hard work. Welcome back to the next session with me on financial management. We met last while we discussed cost of capital, I guess, and I'm sure since then till now you have traveled through a journey of not only on that topic but some other topics as well, and you're gaining some confidence on the subject as such. So those of you who are attending this session for the first time. So this is Chartered Accountant Manubhav Verma. I'm back at your service, and between today and Monday, we will have a very interesting, discussion on capital budgeting. And I can see a lot of action already on the query panel. Sudhanshu, Darshan, Bhumika, Manisha, and Komal, Chanchal, everyone. Good evening, all of you. So today we will be, giving you a little bit of heads up of, what is capital budgeting, why it is important, what are the various decision metrics a financial manager can be faced with, and what are the different techniques to evaluate, the projects. Now, before we even start that, my usual style where I, pitch in a particular session is to actually throw a question at you guys. Now, the question which I want to ask you is, don't worry about that. It's not a scary question. It's a repetitive question for most of you. I believe that the capital budgeting discussion is relating to one of the one of the decisions that a financial manager needs to take. I'm sure each and everyone is aware, right? Which is that decision? What's that decision where a financial manager is faced with when we are discussing the capital budgeting techniques? Let me see how many of you respond that. 3 decisions, right? There are 3 decisions which a financial manager is generally responsible for, one of which relates to capital budgeting. I think anyways, we had discussed cost of capital. You guys have also discussed capital structure. So I'm pretty sure that the other aspect was the financing decision, which you guys are very well versed with. But now what I can see is based on the responses that everyone is aware that yes, we are talking about investment decision. Yes, Said, yes, Jay and Harshita. So Darshan as well. So yes, so we are talking about, so after we have taken care of the financing decision, it's important to understand, where do we invest that funds to get the optimum return. So we are talking about optimum utilization of the funds here. And the idea remains the same. The objective remains the same of the financial manager. That's the wealth maximization, folks. And very important that we need to understand that, bearing the cost of capital in mind, every single rupee bears some cost along with it. So it becomes a very significant matter that, how that single rupee raised is invested in a utter prudent manner. That's very important. Now, capital, budgeting as such, of course, involves some steps where we are talking about, okay, where do we invest? We need to probably identify the investment avenues that could map with the business objectives, strategic objectives, I would say. And then we also need to consider, once we identify those projects, what are the different returns we anticipate from those projects? What is the investment required in those projects? Accordingly, we select the investment proposal which becomes more attractive, not only in terms of maximization of returns, but also balancing any risk associated with that. And of course, once we select that particular project, we should not stop there. We should make sure that we keep on a check. We focus on the control and review aspect. So a very, very important aspect I would like to mention over there when we're talking about these capital budgeting projects, we are focusing on a very interesting element or a characteristic rather than just a bare returns or a projected net income. We are talking about, guys, a post-tax incremental cash flows. This will be a very, very interesting point of discussion, guys. We'll be talking about how this is different from accrual. We are not even, discussing anything with respect to net income or accruals here. We are purely talking about the cash flows. Darshan says capital budgeting investment decision is the same. So yeah, so Darshan, investment decision is something a financial manager is responsible for, and capital budgeting is definitely the technique to kind of enable you to take that decision, right? So that's basically with respect to the steps in the capital budgeting, and of course why this is important. That's very significant to understand, because of course the investment requires huge money, right? So huge financial resources are at stake. And are they in abundance? Is the capital in abundance, guys? I don't think so. Generally, you will not have unlimited funds, right? So you will have let's say limited funds based on a budget allocated. So one thing is that yes, there are huge funds involved. They are scarce, and the interesting part is these decisions are generally related to the long term. It's your money will be stuck for a longer period of time, so you need to be really patient on that. Not only that, once you are invested in a business, you really cannot come out that, oh gosh, I made a mistake. Let me make a U-turn. Let me reinvest in some other project. No, sorry, that's not possible. At least not possible with the same amount. You may have to, bear a significant loss for that. So that is why very safely we say that generally that these decisions are irreversible in nature. Because once we have entered into a contractual obligation, generally we cannot reverse. Yes, if a reversal is possible, maybe after payment of significant penalties, suffering huge chunks of loss, who would like that? And of course, most important thing which I was talking about, that element with respect to the cash flows, guys, that element is also adding to the complexity here. We are talking about future. We don't know what is going to happen tomorrow, and we are talking about 5 years. Right, so we're talking about how do we assess this cash flows? What are the cash flows associated with different projects? So it's very important that we understand the criticality, the importance of the capital budgeting decisions, right? So as I already said, that it's a good significant process involving various steps, starting with the planning. Everything starts with the planning, right? So and with the planning, as I said, we are looking at identification of the investment opportunities, guys. That's what the focus is. We have arranged for the funds. We want to invest in. An investment is not just for a fun's sake. We are basically mapping it with a mission statement, with the objectives of the organization. And once we identify those various opportunities, we basically evaluate them by comparing not only the funds involved in them, but also returns associated with those, along with the timings of the same. And then based on that evaluation, we would definitely have to choose. And we will talk about this particular aspect at some stage. Can we choose one project? Can we choose multiple projects? Can we select a particular project in part? All that will be discussed. And then once we have selected a project or projects, it's the time, it's the action point, guys. It's the field work, it's the run bhumi. You have to implement that. And once you implement that, you need to ensure that you keep things in check. That's a very, very important aspect, whether it is going as per the plan or not, whether it's a successful selection or you are saying that, okay, there are certain, nitty-gritties which you kind of missed out. You want to incorporate that. So all that is a part of the control and review process, right? Now, broadly we can say that there are, a couple of categories of these capital budgeting decisions. One could be categorized as something which is based on a decision situation. And other is based on the firm's existence as such. Now, of course, both are significant in its own sense. When we say firm's existence, so you are posed with a situation where the existence is a question mark. So what about a business is working on a particular technology for decades now? With the times changing, with the AI in place, with the robotics, everything, do you agree with me that really you cannot survive on the old dated technology? You need to move on, and hence when you need to move on, you have to opt for modernization. You need to probably go for replacement of the old style machinery to the new types. Imagine, I'm sure basically everyone is aware of a lot of kitchen appliances these days, right? Let me give a practical example onto this. And I'm sure some of you might have heard that. You guys can add on the chat on the query panel in case you have heard about this. So when we talk about these modular kitchens, and I'm sure some of you might have witnessed the modernized kitchens, which have been very common over the last decade. We talk about the chimneys, we talk about the inbuilt gadgets with respect to this, dishwashers and so on. So all the kind of multinational, opportunities or the gadgets which are kind of coming our way as well. So there's something which is already on our way and pretty much common in other countries called robotic kitchen. Imagine what will be the scenario in India, right? The females sector or people who are responsible for the cooking are basically sitting on that couch or a sofa, so reading a magazine or watching Netflix, and you have a robotic kitchen, just on the place of above the stove. So what's happening over there? That the robotic kitchen is moving here and there, like a chimney. Chimneys are fixed, but a robotic kitchen will be moving here and there and probably cooking for you. You're talking about just need to be ensure that you put the right things in the right slots over there. You can't add a sugar in the slot named as salt. You really don't want to do that, right? No one likes a salting halwa, right? So we can't even imagine, how things will be like. I can already visualize this. Imagine how the robotic kitchen will be, advertised in India. They will say that, okay, let's say a company like Philips or Inalsa coming with a robotic kitchen with 21 inbuilt dishes, with 21 inbuilt, menu or different recipes, and then other companies, Sony coming into picture, Samsung coming into picture with 95 dishes, with Italian, with Chinese. No, my intention is to teach capital investing here. I'm not here to make you hungry, right? That is for sure. But I'm just giving an example here how things will change. How things have changed. We're talking about new product lines, markets here, diversification. This can actually change the agenda, the entire existence, entire paradigm of the industry here. Think about, guys, who would have thought, ask your parents, ask your elder siblings, who would have thought 12 years back, or 15 years back, ask your elders, who would have thought if you go in a metro and if you see left or right, you would see 99% of the population just on the mobiles. Who would have thought that? The biggest example. So basically what we're talking about, these are big decisions. We're talking about, okay, it can boil down to the business survival, the firm survival, right? So that's one piece. Now, other could be like more of a regular decisions where we are talking about basis the decision situation here. Now, when we are talking about decision situation, of course, we may be talking about some mutually exclusive decisions. So this is important term for you guys, which means that the time you select one project, that means automatically the other projects are rejected. So that's mutually exclusive. That means acceptance of one means rejection of others. Then we have accept or reject decisions. So I can see a couple of examples, like Chancel mentioned microwave. Yeah, Chancel, even microwaves had a different technology these days, right? I've seen abroad, you have microwaves in kitchen which can be given a command when you are on the way, probably 3 kilometers away also. So again, that's a different ball game now. So accept, reject decision. So we're talking about a particular project. Should we take it up? Should we not take it up? Generally the criteria is probably comparing the returns with the cost involved, right? Contingent decisions, where the name suggests that, okay, that this particular project may be dependent on some other factor. Let's say some additional investment, some returns, some anticipated funding. So these are contingent decisions. So these are based on the typical decision situation, which could be recurring for a business, which could be a routine for the business, but it may not be paramount to the firm's existence as such. I hope this is clear to everyone, guys. Any questions so far? All doing good? First 10 minutes, just a health checkup. I hope everyone is having a normal pulse. Let me check the query panel. Any questions? So far, so good, right? It seems everyone sounds okay here. I hope people are not hungry after that example. Great. So yeah, first important aspect, as I said, let me actually go back to the couple of slides. Guys, I told you that we will be focusing on one important aspect, that is post-tax incremental cash flows. That will be the agenda, very important agenda before we even go to deep dive of the capital budgeting techniques. So that is where we start from. Project cash flows, guys. You really need to be drowning in the cash flows like you can see in the image. Now here we are only considered about what is going to change, guys. What is my incremental cash flows? So when I'm saying what will be my incremental cash flows, I'm just considered about, okay, hey, I'm spending $100 already. If I take up this project, I'm spending $170. I'm considered about that additional 70. I'm earning 50. If I take up that project, I'll be earning 90. I'm only concerned about that additional 40 incremental. Of course, make sure that we are talking about the tax implications also being taken care of. Now, when it comes to cash flows, that means we are absolutely giving it a pause to accrual concept. We're not even considered about accrual accounting right now, matching principle. No. We are talking about cash flows because it's all about the liquidity, the funds involved to be invested. So we are just focusing on the cash flows for the time being. Don't worry, we are not challenging our financial accounting. We're not challenging our accrual concepts. That stays there itself for external reporting. We are talking about incremental cash flows here. So, and of course, cash flows are pretty much different from the accrual timing and all. Now, what are the factors to be considered, guys, one by one? We're looking at depreciation first of all. Depreciation, as the name suggests, is non-cash, but interestingly, this will be giving some saving in tax. Why? Because it is a tax deductible expense. As you record depreciation, guys, what happens? That your taxable profits gets reduced, hence tax will go down. You know, in accounting, when people think depreciation, you know, many people define depreciation as a wear and tear, matching principle. Many people define depreciation as that. But also imagine, do you agree with me that another perspective, different perspective I'm sharing, that depreciation is also, or rather can be considered as, separating out some distributable profits every year. Because once you record depreciation, your distributable profits will go down, will not be paying that much dividends. And you are basically indirectly providing for the funds for replacement of the machinery 5-7 years later. Another different perspective to look at the depreciation. But having said that, our focus with respect to depreciation is the tax saving associated with that, because tax payment is an outflow and it results in a tax shield, guys. Now, what we need to be careful about is, as per our Income Tax Act, we understand there is a concept called block of assets. That means if there are other assets in the block, when a particular asset is sold, then there is no gain or loss till the time only the last asset in that block is sold. And hence, we will be considering any gain or loss or tax implication on that when that last asset is sold. Otherwise, gain or loss can be ignored till that point of time, right? So very, very important, depreciation. Let's talk about the others. Another concept called opportunity cost, guys. Now, what's opportunity cost? Cost of the next best alternative. In this case, we are saying that any foregone benefit to be taken into account. That means, so let's say this is a factory here. Now, this particular factory, it has a separate out section here. Can you see that section here, which I'm trying to draw? Now, this section is being let out currently. And this is let out at the rate of 1 lakhs per month. Now, if particular section is let out, what is happening here is, that means if you want to expand the business, you will have to get that vacated. You will need that space. So opportunity cost would be that rent you were earning, guys. Guys, are we okay with that? If you're earning 1 lakh rent from that factory space, and now you want to expand, you want to get that vacated for your business, that is opportunity cost. 1 lakh net of any tax implication on that. Kiran says did not get it. Kiran, what happened? What is the point you want to ask? Are you considered about depreciation? For that, I can show you the slide. If your question is depreciation, guys. Kiran, can you confirm if your question is on depreciation here? Any other doubts from anyone? I'm just going back to that query. Okay, so let's talk about this depreciation tax shield. Just for the moment, because I think some of you did not get that. The first point. I will come to the opportunity cost in 2 minutes. But right now, let's focus on depreciation tax shield here. Now, there are two methods, guys. I want you guys to be very careful. Look at one method at a time. Look at the left-hand side. Look at method 1 first. In method 1, what we are doing here is we are having a earning before tax and depreciation as 50,000. After that, we reduce it. We subtract the depreciation from it, and we get earning before tax. And let's say the tax is 30%. My profit after tax is 21. So Kiran, I hope you understand that depreciation is a non-cash expense. And because it is non-cash, we can add it back to calculate the cash flows. Kiran, I hope this much is clear. So first we reduce the depreciation. We then apply the tax percentage. We calculated profit after tax, and then we arrive at adding the depreciation back again to be arriving at cash flows of 41. So I hope this part is clear to everyone, guys. Now, other way around is you need to also understand that, guys. Let's say I give you another method here. Here I say that, okay, my earning before depreciation and tax is same, 50,000. I absolutely ignore depreciation at all here. And I calculate the tax 30% here, 15,000, and I come to cash profits. Look at this term, because there is no depreciation. Syed, I will come to your query in a couple of minutes. Once, let me cover this depreciation first. So this is cash profits because there is no depreciation. And what will happen is, guys, look at this. What was my tax earlier? What was my tax earlier, guys? When depreciation was being charged? Can I draw an arrow from 15 to 9? My tax, if depreciation was there, went down from 15 to 9,000 in method 1. That means there is a savings of 6. We're talking about savings of 6,000. So what we are doing is we are ignoring the depreciation initially, and then we are adding back only the tax savings. Tax shield means tax savings. That 6,000 is added back, and to your surprise, and rather I would say to your no surprise, you're getting the same answer. Whether you follow method 1 or method 2, you will get the same answer. So it's up to you. How do you want to understand the tax sheet? Great, Kiran, thanks for confirmation. Okay, coming back to Syed's question here. Syed asked the question on how is diversification modernization different from a firm's decision? As they do require decision by the firm. Okay, Syed, when we're talking about the firm's existence, so it's important that when I'm talking about diversification modernization, we are considering that aspect that, okay, if you stick to traditional ways always, at a point in time, you are forced to diversify. Otherwise, you will be, kind of pretty much left behind in the industry. We're talking about that, that context. If it is a routine diversification, then it's a decision situation, right? In that context, you will be right. It is a routine decision, then it is on the right-hand side. But if it is absolutely on the mark of the existence of the firm, then of course, and that becomes generally, once in a decade. It's not an everyday situation, of course. Sayed, I hope that makes clear. Okay, so coming back to the factors to be considered in the project cash flows. I was explaining the second point. What was that? Opportunity cost. Now, opportunity cost, we discussed that, okay, if there was a separate section of a factory that was let out and now you need to expand, you need to start up a new project, you need to get that particular section vacated. And if we need to get that section vacated, we will not be getting that rent anymore. We are not getting that rent back. And that means that 1 lakhs would be my opportunity cost, but any tax associated with that, because that 1 lakh rental income would have increased my tax, let's say tax of 30%. So my 70,000 will be my opportunity cost. Next point, we talk about sunk cost. Now, sunk costs, as the name suggests, that these are costs already incurred, which do not impact my decision. Like at what cost do you purchase the existing machinery 8 years back? It is not relevant. You can ignore that. It is not incremental, guys. It is in the past. Okay, that's sunk cost, not relevant. Another important point, guys, I'm looking at working capital, very important. Now, what happens is generally when you add up a project up your sleeve, you may need some additional funds. You know what will happen is your inventory will be increased. Your account receivable may increase. You may need some additional liquidity. Your vendor's balance may also increase. Darshan, yes. Outlay is basically outflow, right? It could be expenditure, it could be investment also. Okay, so working capital, you need additional working capital. Now, interestingly, what happens is, with working capital, there could be different scenarios. Let me take an example. Just give me a quick second. I want to show you an example here with respect to the working capital. Okay. So let's do this. Let's take 3 different scenarios here. Now, the first one is the most common one. Now, what's that? When you end up having a new project, you will generally have an initial increase. You will have an initial increase in the working capital. So let's do this. Let me use this arrow, upward arrow, initial increase in working capital. That means at the end of the project, you may not need that working capital again. So in the last year, in the terminal year, end of the project, the working capital requirement may reduce. So that means initially there could be a situation where your working capital will result in an outflow of funds, but at the end of the project, it probably you can release that funds blocked in the working capital. You don't need that anymore. Hence, it will be an inflow here. So initially, it will be a cash outflow, and later on, it will be an inflow. Okay. Now, let's also talk about another scenario where some practical cases. What happens here is, generally, when we are talking about working capital, let's say this is a tenure of the project, and this is the amount. What we are looking at is, let's say initially you have some working capital required. After 2 years, you need some additional working capital. Then again, after 2 years, you may need more working capital. So probably what we're looking at initial outflow, let's say after a couple of years, and another outflow after another couple of years. So basically the working capital requirement is based on the project levels, right? You are expanding. This could be a scenario. And you need to be very, so again, you don't have to worry about that, but we need to be careful that we read the question properly. We need the, read the situation properly and accordingly evaluate. Interestingly, there could be a third possibility. Let's say we talk about the reverse scenario. Example, automation. Now what will happen is in automation, let's say you want to experiment, you want to take a chance of a particular project. Let's say you want to go into a completely automated mode from a man-made or a human based production. And generally that would mean that initially your working capital requirement may go down. Because you are going into automation mode. You may not want to have so much of inventory. You may not want to have so much fund stock here. This is rare though. I would say this could be rare in the questions. But still we need to know. And then once the project is complete, you would want a working capital level to be reinstate. And when I say reinstate working capital, that means you will be actually increasing, it will be an outflow. So initially it is a release of working capital, that's inflow, and later on it is an outflow. Darshan is asking a question, how the requirement of working capital in terminal year is decreased? Darshan, I assume that you're asking about the first particular scenario. Once the project is over, you don't need those funds. Darshan, once the project is over, you do. So this is the most common case in the questions. That you will need some working capital in the initial year. Let's say I want to start a project which will be going almost till 5 years. And this project requires additional working capital of let's say a couple of lakhs. Now, if I have to invest those 2 lakhs today, what about 5 years later once the project is over? Why would you leave that funds blocked unnecessarily? You would withdraw from that project and invest somewhere else. So for that project evaluation perspective, that becomes inflow. I hope everyone is okay, guys, with working capital possibilities. Everyone, guys? Kindly confirm. Say the reverse scenario is like, let's say there is an automation. Automation means you may not need some bit of labor force. Your processes are so perfect that you may need a reduced inventory. And in that case, your existing working capital requirement may go down. You want to try that automation for 3 years. And then once that automation is complete, you will have to go back to the older style. Your working capital will increase. As I said, it is a rare scenario, but don't be shocked if it is there. Makes sense to everyone, guys. I hope Bhumika, Chanchal, thanks for confirming. Great, guys. I think amazing. I think your participation is very much appreciated. You guys are asking questions when it is a concern, and of course you are also confirming when things are clear. Great. In third case, Kiran says, Kiran, that will be initial investment. Now we're talking about working capital. Kiran is saying in third case, automation will need more funds. Where initial investment is a different thing. There will be initial chunk, like any project would need 5 lakhs, 10 lakhs, 25 lakhs, or 50 lakhs, or even more. So Kiran, you are correct. That is anyways outflow. Okay. So working capital is taken care of. We move to the next one. Next one is talking about allocated overheads. In allocated overheads, we are looking at only incremental need to be considered. Guys, what happens is let's say there are overheads being incurred and overheads are allocated to different departments. If you're starting up a new project and some overhead is being allocated to that project, that doesn't mean you need to consider that unless because of the new project there is some additional overheads. So again, the focus is on incremental. If at all there is an incremental. Jay says, please explain reverse scenario again. Jay, what happened? The reverse scenario, I said it's you could probably ignore that, but again, just that if you talk about advanced technology, so good point by Karthik. Karthik says, investment. Okay, so Karthik, I will come back to your point in a while. So your point is a different point. So Jay, reverse scenario, what will happen is if you are going from let's say man-made production to automated production, so you will require less inventory, you require less labor, your less funds will be required. Probably initial investment will be there, as Kiran said. That's a different ballgame. But as far as working capital may be considered, you may not require your initial working capital requirement may go down. And once the automation trial is over, you may have to reinstate that, a working capital. Jay, I hope that makes sense now. Karthik raised a very interesting point that investment made in artificial intelligence. So I don't want to read out that, Karthik. You understand why? Endangered to the profession or what? Everyone knows that. Okay, we are moving towards the point where we are ourselves, could be responsible for replacement of ourselves. So I think everyone knows that. I think the best way to safeguard ourselves is to be with the time, or rather to be ahead of the time. And almost for a long period, fintech has been the call of the game. So once you guys are qualified CAs, as far as the CA curriculum is concerned, of course, you guys anyways will be equipped with decent knowledge on IT front. But then, of course, your corporate experience, your additional certifications can help you to kind of move along with those directions that, that you become irreplaceable as well. So I think things may not be completely beyond your control, but Karthik, good point raised. Darshan, I will not answer that question because Darshan is asking whether the net cash flow from working capital is zero. No. Darshan, we will see that in questions. If question says initial working capital is increasing, we will increase that. Right? So if there is an increase in working capital, it means outflow. So Darshan, I'm basically intentionally parking that question. We will see that in how the case study is being given to you. Because that question can be answered differently also. Okay. Next one, guys, operational savings or cost reduced to be taken net of tax. Now, in the new project, there could be some additional revenue you are anticipating. So you will say additional savings, revenue minus expenses, or just the example I gave you of automation, there could be reduction in cost. So either the new project is operational savings or it could be reduction in cost. Both will be taken net of tax. Because if you are talking about additional profits, that will be exposed to tax. If you talk about saving in cost, that also would increase your profit and hence net of tax. So make sure that we consider tax implication, guys. And of course, I think some of you raised that point that we are talking about some additional investment at any stage. Like I also told you for working capital or anything, that will be taken into account. But my friends, one of the most important point mentioned at the bottom of the slide here. If you are given a profit and loss or income statement wherein you are talking about net income and you're adding the depreciation as a non-cash expense, that's a very good job. But make sure if that income statement, if that profit and loss also have interest amount as being deducted, please you have to ensure that even interest has to be ignored. We cannot really consider the profit net of interest, no. Because we will soon see in capital budgeting, we are talking about evaluation of a project over 3 years, 5 years, 7 years. And in that case, what we will do is we will discount. We will discount the cash flows in the future years to the current year for the project evaluation. And we will talk about what is discounting. When we discount, we will multiply the cash flow upon 1 upon 1 plus r to the power n. We talk about the discounting, guys. And if we are discounting it, then why should we consider interest also? This will be a double impact there. You can't reduce the profit by interest and then discount them again. It will be a double dip. Guys, I hope everyone is okay. That means if interest is reduced, we have to add it back. Make sure we understand this point, because anyways we'll be discounting those cash flows. Okay, one thing I want to check. How anyone is not sure about discounting, or everyone is pretty sure about the discounting point? How do we discount the cash flows? How do we discount the cash flows? Is everyone comfortable on that? What is the discounted cash flow? Well, even if you're not, let me give you a relief that you learned the cash flows discounting, or rather you learned the discounting concept right where when you were in school many years back. And you might be surprised how the hell I'm saying that. Let me tell you. Yes, you guys have learned simple interest and compound interest. Are you guys familiar with this formula? A is equal to P into 1 plus R to the power N. Are you guys familiar with this formula on the top? A is equal to P into 1 plus R to the power N. I think something called a compounded interest. Am I correct? Can anyone confirm this, guys? Okay. Now, if I just take P on this side and take 1 plus R to the power N in denominator, guys, that's what is the discounting is. That's what the discounting is. Did you ever think that? Your compounding interest formula had the discounting element. So P is the present value, A is the future amount. I hope everyone okay. So if for the first year it is 1 upon 1 plus R to the power N, for the second year it's 1 upon 1 plus R to the power 2, and so on. Everyone okay? Great. Thanks for confirming. We now bifurcate these cash flows into 3 particular stages of a project. One is initial stage of the cash flows, like initial project, like you're talking about probably a year 0. Darshan says, how does a double effect when financing costs are not excluded? Darshan, because your interest is reducing your profit and your discounting is also reducing profits. Interest, when you take interest as an expense, it is reducing your profits. When you're discounting the profits, then also it will be, reducing double. You'll be reducing the profits or the cash flows, double. Okay, Darshan, I am sure you are pretty clear. And this particular note has been also emphasized in your study material, guys. Please go through that as well. Okay, so let's understand initial cash flows, guys. And many of you agree that most common is your initial investment. That's the cost of the new machine installation. As I said, investment in working capital, very rarely it could be savings also. And what about if you're replacing the existing machinery? There could be sale proceeds of the old asset. But if it was the last asset in the block, it could be gain or tax implication on that gain or loss as well. That's the initial cash flows. Then we talk about interim cash flows. In interim cash flows, it means project during the project term. So here, if there is a new project, of course, we talk about this. We have already learned profit after tax plus non-cash expenses like depreciation. If it is a replacement, then we are only focusing on incremental revenue or savings, net of tax. And of course, there could be additional working capital, like in my second example, right? There could be additional working capital in between, as given in the question. Now, terminal year cash flows means last year of the project. Of course, last year is also in year, right? If the last year is also in year, there could be the cash flow for the last year, which could be savings or the revenue. That is very, very obvious. So if the project is for the 5 years, this is year 0, that is today. Interim cash flows would be from year 1 to year 4. And terminal year is year 5. And of course, year 5 would also give you some, incremental revenue or cash flow. So that is very logical. But once the project is over at the end of the year 5, there could be salvage value of the asset. And if that asset is last asset in the block, it could be tax implication as well. And your favorite point, friends, which many of you used to forget when you used to do this at your graduation level. If you are talking about the increase in working capital initially, please do not forget that you have to do the opposite at the end as well. So if it was an outflow initially, it will be an inflow later on. If it was an inflow initially, it will be an outflow later on. So whatever you did initially with the working capital, generally you will release that at the end of the project. So basically what we are doing here is we are bifurcating the cash flows into various stages of the project so that we can understand how the evaluation will take place. And this is a classic example on your screen. We are looking at a calculation of a cash inflow net of tax. You can see that some sales, less variable cost contribution, then you're talking about less fixed cash cost that will be considered. Depreciation will not be considered, and that is why that is being added back later on. And you can see also no interest is there. So it's a classic chart. Kiran, that's fine. Even if you have not covered that, we are going into the details. So some people, while pursuing their graduation, have covered that. Some people may not have covered that. That's okay. We are not even assuming that you have covered that, but generally the tendency is that students miss out that last section. That that is why it's important that release of working capital is important for us. Okay. Last asset means Shubham, last asset means the block of the asset. I already explained in the beginning, in Income Tax Act, there is a concept of block of assets. So there is no gain or loss until and unless you sell the last asset of that block. Last asset means last asset of that block. Make sense? You can say that, Darshan. I don't want to change the terminology. I'm just saying that don't take interest. Okay. Great. Now let's dive into some capital budgeting techniques. As we all understand, the idea is the wealth maximization. The idea is to maximize the return to the shareholders of the company. And generally, how do we do that? We are talking about selecting the project which could be most profitable investment. And of course, if it's a bad decision, of course, there could be very much devastating for the organization and its strategic plans, as we discussed on the first slide. Now, our major agenda would be on discounted cash flow techniques, but from a theoretical perspective, we will talk about traditional techniques also. There are a couple of traditional techniques which can be easily criticized because of its non-discounting nature. That means it ignores the time value. Ignores the time value. Now, we will just talk about these two as well, that is payback period and accounting rate. But our major focus will be on the discounted techniques, net present value, profitability index, IRR, modified IRR, and discounted payback. My viewpoint will be if you understand these two, net present value and IRR, you will automatically understand others. Other methods like modified IRR is extension of IRR. Profitability index, discounted payback are also pretty much basic, but the most important one would be the NPV and the IRR guys. But to start with, we will be talking about the non-discounting techniques. First one is a payback period. Now, as the name suggests, Before I will go to that point, I want just probably a comfort level from all the students, guys. Everyone doing okay? So may I ask a different question this time? How is the Josh? How is the Josh with everyone? Just want to quickly check. Any doubts so far? All doing good? Great. So everyone is like high, sir, very high. Okay, great. Bhumika, Kiran, thanks. Almost a year and a half back when I asked this question, how's the Josh? Some students replied me that Josh is with Katrina now. So I was like a little surprised with that answer. But yes, I would rather say that we can focus on financial management for the time being. So we're talking about the non-discounting techniques, payback period, as the name suggests. We have considered that in how much time our investment will be back into our pockets. So that means it is the length of the time required for the cumulative total net cash flows from that investment to equal the initial cash outlay. So for example, if you're talking about 10 lakhs out, then in how much time? How many years I will get back the 10 lakhs? Of course, we're talking about the payback. And in this case, generally, we are only focusing in the case of risky projects. You will not consider payback period in other projects, but if the projects are risky, you will probably think of payback. Of course, you need two things. One is your initial capital investment and annual after-tax cash flows. So that's how you'll be calculating cumulative total net cash flows, guys. So you need annual after-tax cash flows for that. And then there is something called a payback reciprocal, which is basically an approximation of IRR. We'll talk about this later, not now. It's a close, close approximation, I would say, of IRR, where we say that okay, if the project life is kind of more than twice the payback period, and we are looking at project generates uniform cash flows. See, the idea is that this is generally based on a non-discounted technique. So I would not say that, okay, it's a good idea. We consider this as an IRR. So let's say a payback period is 5 years. A payback period is 5 years. A payback period will be 1.5. That is 20%. So we'll say that, okay, the reciprocal payback is kind of approximation of IRR. Generally, when the project life is, twice the payback period. So again, that's the assumption behind that. So for example, my project life is 10 years and the payback period is 5 years, then probably we can safely say that is quite similar to IRR. But don't worry about this right now. We'll talk about IRR calculation later. Okay, how do we calculate payback period? How do we calculate payback period? Let's do one thing. Let's kill two birds with one sword. We target to cover payback period, and immediately after the payback period, I will also tell you what is a discounted payback, because you need to understand the aspects parallelly. So let's talk about the payback period first. There could be two possibilities in a project. One, where you may get similar cash flows. We also call it as a uniform cash flows every year. In that case, it is easy work cut out, a shortcut here, that you can calculate a payback period is initial investment divided by annual after-tax cash flow. It is only when the cash flows are uniform. So for example, a project is costing 10 lakhs, yield annual profit of 3 lakhs after depreciation of 20%, but before tax of 50%. So what will be my after-tax cash flows? Your after-tax cash flows will be 3 lakhs minus 50%. That is 1,50,000. And then you add back the depreciation. So depreciation is straight line. So 2 lakhs of depreciation is added back. And hence we are getting at 3,50,000 is a after-tax cash flows. I hope you understand this. 3,50,000. And hence, because it is every year is the same amount, my payback period is 10 lakhs divided by 3 lakh 50, 2.86 years. So roughly in 2 years, and let's say how much we can say, probably 10 months, whatever. So 2.86 years is what our money is coming back. Interestingly, we are not bothered about what's going to happen after this. Is this project giving so many returns after 2.86 years? That's what we are not considering, and that is the drawback, guys. Payback period method has two drawbacks. One, that it doesn't consider the profitability after the project, and also it is not even considering the time value of money. It's not a discounted payback, it's the payback period we are talking about, right? What if you have uneven cash flows? What if you have uneven cash flows? In that case, you cannot really divide initial investment by a specific amount. Every year amount is changing, and hence we calculate cumulative cash flows after tax. Whatever after tax cash flows, you cumulate them. And then we will talk about the payback period when it covers the initial capital outflow. It could be even a fraction of the year. Now, I would say this can be used even for uniform cash flows. It's just that since it takes some time, we had a shortcut for that. So initial investment upon uniform cash flow is just a simple answer, but you can actually follow just one strategy, whether it is uniform or non-uniform. You can calculate cumulative, you'll get the same answer. So let's see this. So the example is project costing 2 lakhs, yields following after tax cash flows. So we are talking about 1 lakh here. So cumulative 1 lakh, 1 lakh plus 80,000, 1 lakh 80,000, 1 lakh 80 plus 60, 240. And then 240 plus 40 is 280. Now you can see the project cost is 2 lakhs. It is between 2 and 3 years. It's in the third year. The project is recovering its capital in the third year. So what's going to happen here? If it's recovering the capital in third year, we'll say that, okay, definitely the payback period is in the third year, falls in third year, but what fraction? So we'll say 2 plus, and after second year, what is my cumulative cash flows, guys? 1 lakh 80. How much is yet to be recovered? 2 lakh is my project cost. 1 lakh 80 is already recovered. So we're talking about 20,000 is yet to be recovered. All good? 20,000 is yet to be recovered here. And if 20,000 is yet to be recovered, in the third year, the total after tax cash flows is 60,000. That means roughly 20,000 upon 60,000 is the third year portion, 1/3. And hence the payback period is 2.33 years, guys. 2 years and 1/3 of a year. Guys, need a quick call. Everyone okay till now? Cumulative cash flows fundas all clear, guys? Darshan says, what if the cash flows does not reach the invested amount? You're not going to enter into that project, my friend. If you're not even recovering your investment, you will reject that at the time of evaluation. I hope everyone doing good. Yep. Now you can see the advantages of this method. We are saying, pretty basic stuff. That it's simple, easy to understand, gives a high level of estimate of risk. So this is where I said that you could risky projects, this could be good. However, it major two disadvantages: it ignores time value and it ignores profitability after payback. Ignores the long-term project. It will favor those projects where the capital is recovered quickly, but it will ignore those projects where there is a long-term profitability. Now, what is a discounted cash flows also? Or rather discounted payback period, it's pretty much the same. The only thing is, instead of the after tax cash flows, we will be taking discounted cash flows. We'll be taking discounted cash flows here. And I'm just taking an example here on the left hand side, just to explain you how this discounted payback happens. Let's say the first year cash flows. So everyone understand that discounted cash flow will be lesser than the cash flows, undiscounted. So let's say first year discounting comes to 90,000. I'm taking an example. Let's say second year comes 65. Third year becomes 43. I'm just taking an example. Don't start calculating, what is the rate I'm using. Just take an assumption here that these are my discounted cash, so whatever the rate is. And then we are looking at roughly around 25,000 here, let's say. So now, in this case, if I calculate the cumulative cash flows, first year is 90, then we add up to 65 is 155, and 155 gets added to 43, gets 198, guys. Can you see that? 90 plus 60 is 90 plus 65 is 155. So if I want to mention my cumulative discounted cash flows, we are talking about 90, 155, 2, no, it's 2 or it's 198 actually. Let's mention 198. And then it is 223. So we can easily say that in terms of discounted cash flows, my discounted payback would be even longer. Why? Because it is not even covered in 3 years. 3 plus 2 upon 25. Because after 3 years, it was 1,98,000 only. I want you guys to understand discounted payback also. That in discounted payback, that the period will be longer, guys, because we have discounted cash flows. Discounted cash flows are lower in number. So it will take much longer to recoup the investment. Everyone okay with that? Don't worry, I will just touch base with that later on as well. But I'm just kind of giving you a good pretext to compare discounted and undiscounted. Non-discounted or a normal payback period, it will be definitely shorter than a discounted payback. Discounted payback will be a longer period with the same project. Because in discounting, your cash flows become lesser using smaller numbers. Okay, great. We move to the second non-discounting technique here. Now, in this one, this is called an average rate of return or accounting rate of return. Now, this can be criticized for multiple reasons. Actually, the point is that when we actually try to do a capital budgeting decision, make a capital budgeting decision based on accounting income, you probably are not doing the best of the job, because your net income could be based on a lot of estimates, a lot of provisions, a lot of whims and fantasies of the management. So really cannot always go for the net income. But still, for internal decision making purposes, you never know, and that's why we need to just learn this method. That the formula for accounting or average rate of return is, we are looking at average annual net income. So probably we need to calculate the net income of 3 years, 5 years, and divide it by 3 or 5, and divided by investment. So that's average annual net income upon investment. Now, the interesting point is I already told you what is the numerator. So whatever the net income is, you average it out. But the critical part, which is a little tricky here, which is more of a investment. Where investment could be measured in multiple ways. Either you take the entire initial investment, or you could take average investment over useful life, or you could calculate ARR for every year and then average out the ARR for 3 years or 5 years. Calculate the ARR for 3 or 5 years separately. Now, another interesting situation becomes when there is a working capital. Look at this formula. It can be really acting as a bouncer initially. Now, I'm not talking about IPL here. You can always take a decision review, but not here. We're talking about if additional working capital is needed during the project. In that case, the average investment formula, look at this. Half of initial investment minus salvage value plus additional working capital. Now, why is that? Why we are actually averaging out the initial investment by reducing the salvage value and then we are adding back the salvage value. What are we trying to achieve here? Can anyone tell me what are we trying to achieve? Why we are subtracting the salvage value and then we are adding it back again. And what are we trying to achieve? We are talking about investment here, right? We're talking about investment here. So let's say my initial investment is 1 lakh. And after let's say 3 years, I'm talking about 10,000 will be the salvage value. So what I'm trying to do is 1 lakh minus 10,000, 90 divided by 2, 45. And we're adding the 10,000 back, 55. So why we are doing that? I think the logic is that because that salvage value would be towards the end of the project. And that's why we are taking an average out. Everyone okay with that? See, we are talking about investment. Salvage value will be at the end. We're just averaging the initial investment minus salvage value, and then we're adding the salvage value and additional working capital. That is something we are doing just to ensure that we eliminate the impact that it is one is at the beginning and one is at the ending. Just to average out, we are kind of netting out the initial investment and then we are adding it back. So let's look at an example here. Cisco is going to invest in a project sum of 3 lakhs with a lifespan of 3 years. Salvage value is 90,000. The project profit before depreciation every year is 1,50,000. Tax is given as 30%. Now, what is the depreciation here? Depreciation, your salvage value is 90, right? So based on SLM, 3 lakhs minus 90 divided by 3, 70,000 yearly depreciation. Annual net income is, the profit before depreciation is given as 1,50,000. So annual net income is 1,50,000 minus 70, 80,000 minus tax of 30%. So we are looking at 56. Kiran, I agree this is slightly confusing, but you can read it later once after the class and then you will get the context. So 80 minus 30% is 56. That means my ARR bases the initial investment. So what we are trying to discuss is initial investment can be interpreted differently. It can be as an initial investment only. It can be an average only. It can be different when there's a working capital. So if you see, the most easiest one is basis the initial investment. Your numerator is clear, right? Numerator is clear to everyone. It's an average annual net income. So for example, if 3 years, my net income is different. I have to add them up and divide by 3, average. So in this case, luckily we don't have that case. So 56,000 divided by 3 lakhs, 18.67%. But alternatively, we are talking about average investment over life is the formula I gave you. We're talking about salvage value, half minus 3 lakhs minus 90,000 plus 90,000. So look at my average investment is 1,90,000. Acha, think it that way, guys. Let's think it that way. And I'm sure pretty much you will be understanding this, that if I'm investing 3 lakhs for 3 years, opening plus closing divided by 2 is 1,50,000. Yes or no? 1,50,000. However, we are talking about 90,000 that will come back to us. That is also invested initially. Part of that. Are you getting it, guys? So that 90 is also being averaged. That means additional 45,000 is being also used because 3 lakhs is invested initially, but 90,000 we're getting at the end. So net 1,95,000 is my average investment. I know it is not a vanilla or a crystal clear scenario in terms of the, I would say, justification, but what we are trying to say is that, okay, if you're averaging out the investment, we are taking out the average of the salvage value as well. That's it. So my answer with the average scenario or average investment over life will be different. And alternatively, we can also calculate ARR for differently 3 years, guys. Look at this. This is pretty much straightforward, clear. This is the third method. What was my net income every year, guys? 56,000. This was clear to everyone. And what is the opening investment? Initially 3 lakhs, then after depreciation 230, then after depreciation 160. So every year we are calculating the annual ARR, 56,000 divided by 300, 56,000 divided by 230, 56,000 divided by 160, and we add these all three ARR and divide it by 3. So we're getting 26% approximately. As I said, guys, income is uniform here, but even if the income was not uniform, we may need to calculate the average annual income. In this case, I'm using 56 because across the 3 years it is 56. But if it is different every year, let's say an example, my income in the first year is 50, in the second year is 60, and is 70 in the third year. So what I will do is I will add this up and I will divide it by 3. So my average income will be 60,000 for all the 3 years. If there is a difference in that. I hope everyone is clear on this. Now, I think from a simplicity perspective, net income and these numbers can be taken very straightforward from the financial statements, and that's the advantage here. And in accounting, rate of return could evaluate the management performance. It evaluates the entire life of the project. But I would personally say, and I think you might agree with me, that there are more heavier disadvantages here. Firstly, that there is no time value of money, and also net income can vary, guys, because there could be different accounting policies. There could be different assumptions. It ignores the cash flow, management assumptions, estimations. So all that thing basically is kind of not helping this method to be too famous. Darshan says AR is different in different methods. Yes, Darshan, that's why we are saying that it's not the best method to evaluate the capital budgeting, but still we are going through this. Just that if any management wants to evaluate the performance using ARR, you need to know the method. And who knows, as part of a smaller question, they need you to calculate ARR as well. So just be aware that but don't worry. In the examination, either they will be clarifying, okay, what assumption you need to take for calculating, let's say, the investment. But if it don't tell you that, probably you can calculate it by these 2-3 ways and give you. If you are talking about only initial investment, this is the amount. If I'm taking an average investment, this is the amount. Or if you want to take average ARR, this is the amount. But I would slightly doubt that question would be unclear on that. So don't worry, guys. Okay. Now we move on. Okay, Rajiv says, and Bhumika says, could you brief of all the 3 ways once? Bhumika, I think just keep it simple. When we talk about ARR, numerator is sorted for all the 3 ways. Denominator is different, right? First is the initial investment, and I think Rajiv, I'm also giving your answer as well. Bhumika and Rajiv, both of your doubts. Numerator is fixed for all. Denominator can be initial investment, can be average investment, like we're talking about. Now, in the average investment, it's like opening plus closing divided by 2. But if there is a salvage value and working capital, then make sure that you know the formula. The formula I told you. Half of the initial investment minus salvage value, and then add back that salvage value and working capital. Now, that's your initial investment, if that is the case. And the third way is, Bhumika, the third way is to calculate the ARR independently for all the 3 years, because you would have a average annual net income and the investment, and then you need to calculate the average of the ARRs. So Bhumika, Rajiv, I hope it is clear to all of you. So don't worry, I think a little bit of a uncomfortable zone when we talk about ARR, but we'll very soon going into the comfort zone of the areas where these limitations are not there. Limitations like ignoring the time value of money, different accounting policy, ignoring the cash flows, which doesn't make sense because see, we started studying capital budgeting based on those things, and yet we're not even talking about that. We are not even talking about the profitability or after the payback period. We're not talking about the time value of money. We're not talking about the cash flows yet. Now's the time. Now's the time. I already gave you a little bit of a heads up on discounted payback method though. I already gave you a heads up on discounted payback because discounted payback method will be longer than a payback period because you are discounting the cash flows and the cash flows become reduced. It will take longer to cover the investment. But yes, that's only one of the method. Here we'll be also focusing on NPV and also the IRR. But I think I believe that what we need to understand here is most important aspect that was a disadvantage of the other method is your time value of money. So the most important aspect is that these techniques consider the time value of money by discounting the cash flows to the present value. Because if we are here, if we are standing here, we have an initial outflow here. We have a lot of money coming our way in the subsequent years. So by discounting, we bring all to the today's platform. We discount all these amounts to the today's value. So think about logically, you're kind of buying a gadget, guys. You're buying a gadget or a home appliance from a store nearby you or a shopping mall. Let's say you have two choices, guys. Let's say the two choices you have is either you pay lump sum 1 lakh for that or you pay 40,000 3 yearly installments. Do you really think these are two different offers or almost same? 1 lakh today or 40,000 for in 3 years, like 40,000, 40,000, 40,000. I probably feel that it's almost similar offer, right? You're probably paying interest in the second option. And if you discount those 40, 40, 40, you may come to 1 lakhs. And that is why the different options are there, guys. Different options are there. Generally, when you go for these shopping scenarios, you have two options: pay upfront or get EMI. Right? Now, the first technique is net present value. But before we go there, let's take a quick 10 minutes break, guys. I'm sure you guys need that break to freshen up. So let's do that. Let's take a quick a 10 minutes break. And once we are back, we will deep dive into NPV. We will talk about IRR and stuff, and we'll have a lot of fun. We'll continue to have a lot of interesting discussions. So see you on the other side of the break, guys. Come back soon. Okay, guys, so welcome back. I hope everyone is back after the much deserved break. So let's dive in where we were to start. That is the first method of discounting techniques of capital budgeting here, which is your net present value. Very important one in terms of the examinations and also your understanding. Question says, how is the right discount rate determined? Is it affected by prevailing interest rates? Okay, Darshan, the most important aspect to understand the right discounting rate is what I taught you guys earlier, the cost of capital. Generally, the cost of capital is the most important determinant in that. Apart from that, if there is any adjustment in terms of opportunity cost or a hurdle rate or a management intentionally wants to take a higher rate, then it's a different ball game. But generally, the WACC is the rate that you will be definitely considering. Okay, so now net present value, guys, it's a simple definition. Net present value of a project is the value that is which is a difference between present value of cash inflows minus present value of cash outflows. If there is only initial investment, we can say initial investment also. But let's say if there are multiple inflows, multiple outflows, we will discount all of them to today's value. That difference is net present value. The name is net here. Net present value. Now, when we are talking about discounting everything, obviously it depends on whether we are talking about uniform cash flows or non-uniform cash flow. Doesn't matter, right? The only advantage is if you have similar cash flow, similar earnings or projections are same earnings in the next 5 years, then probably you can use a present value annuity factor. But generally, if you have different amounts every year, we will have to use a different, let's say if the rate is 10%, we will say the first year cash flows will be multiplied by 1 upon 1.10, then 1 upon 1.10 square, and so on. So we will basically depending on which year, what is the rate, right? Okay, Syed, I think let's go back to that review later. I want to just continue with the net present value for now. Probably we can touch base towards the end, right? So we're talking about the net present value again. Now we will discount all the cash inflows and we will also discount all the cash outflows, and we will just see the difference between the two. Now, if my NPV is positive, net present value is positive, we'll probably go for the project. If it is negative, we'll not go for the project. Now, the interesting point is whatever the amount is in the initial starting of the project, do we really discount that, guys? If there is an initial investment, do we need to discount that? Yes or no? Initial investment, or let's say additional working capital at the beginning of the project, do we need to discount some amounts which are being spent at the very beginning? I don't think so. That's a time zero. That's today. Today's 100 rupees is 100 rupees. But tomorrow's 100 rupees may not be today's 100 rupees. Tomorrow 100 rupees will be today's 90 or 91 or 93, depending on the interest rate. So we do not discount today's value, right? So initial investment generally doesn't need any discounting, guys. So what are the steps here? In terms of the steps, we need to calculate as the first step to calculate the net cash inflow in each year. Desired rate needs to be collected, which is generally a weighted average cost of capital, as I just explained. And then we have to find the discounting factor for each year based on that rate, 1 upon 1 plus r to the power n. And then we have to multiply that with those cash flows. We calculate present value of those cash flows by multiplying the discounting factors to those cash flows. We get the present value. And that is the total here. And as I said, the decision is you have to be pretty much on it. If NPV is greater than 0, we are talking about accept it, else reject. And of course, if there are multiple projects and you have, let's say, a relatively good budget, you probably would want to have projects which have a combined positive NPV. Otherwise, if you have to talk about only, probably one particular project, then of course we'll go for the highest NPV project. Now let's see a quick illustration at the bottom, right? Compute the NPV of the project with net investment of 1,20,000 and net cash flows for 3 years are given as 80, 70, and 20. The company's cost of capital is 10%, and they are giving you the discounting factors 0.909, 0.826, and 0.751. So what are we doing here? So basically, we are just talking about a simple factor or a simple table. We are discounting these cash flows every year. Of course, as I said, the first year, no discounting needed. But all the respective years' cash flows are multiplied by the discounting factors 0.909, 826, and 0.751, which gives you the discounted amounts. And when we add them up, is virtually the present value of inflows minus initial investment is giving me a positive NPV. And when it's a positive NPV, the project could be accepted. I think biggest advantage of this method is, of course, the time value of money is considered. Another one, entire life of the project is considered, unlike the payback method, where it doesn't consider the life beyond the capital recovery. And of course, very interestingly, it facilitates, or rather it gives you absolute comparison between different projects to compare with, and it is in line with financial objective of wealth maximization, this particular method. However, the disadvantage becomes very tricky in terms of when we talk about absolute measure. So because I'm talking about difference between present value of inflow minus initial investment, it is ignoring the fact that, okay, some project would have a higher investment, so more stakes are involved. So initial outlay, the significance of that amount, that is something which will be ignored here. And the accuracy of this method entirely depends on your accuracy or your estimation of the cash flows and your discounting rate. Darshan says like the YTM. Okay, Darshan, YTM method we will be considering again and the IRR anyways, right? As I discussed earlier. So in IRR, we'll be talking about the YTM method. So time for some brain teasers, guys. Question 1 and 2 here. You guys need to give your answers along with it. So waiting for your answers for question number 1 first. Bhumika, I did not get you. Wrong discount amount. If you're talking about any calculation error over there, I don't know. 80,000 into 0.909. I think 72720. Don't worry about that right now. I'm sure you can double check your calculations later on, guys. This file is already over there, and I will be uploading, mind you. After Monday's lecture, I will be uploading a new file which will be with the solutions of some of the questions there. Okay, so in the meantime, question number 1's answer, I'm getting D and B. Some people are saying D, some people are saying B. So the requirement is a capital budgeting technique which does not require the computation of cost of capital. Can we say the question's call is which is not a discounted method? NPV, it requires the cost of capital. It's a discounting technique. It cannot be the answer. IRR will require a discounting technique, it cannot be the answer. MIRR always although we have not discussed this, but being part of internal rate of return, even this is also requiring the cost of capital, so not the correct answer. So guys, those of you said D, absolutely correct. So payback ignores the time value of money. It's not discounted payback. So hence option number D is the correct answer. Okay, question number 2, guys. Some of you have already given the answer, but what about others? Question number 2. Interesting question though. What's happening in question number 2? Let's wait for some more responses here. So question number 2, I can see some students, in fact, the students who have answered till now are all in the favor of, mostly in the favor of option number A, but a couple of answers as B also. So in case a company considers a discounting factor higher than the cost of capital for arriving at the present values, the present value of cash inflows will be, yes, if I am discounting with a higher rate, I am dividing it with a larger number, and hence my discounting cash flows will go down. Am I correct? Bhumika, say, think it over. If you're dividing it by a higher number, your resulting amount will be less, right? So for example, 50 divided by 4 is 12.5. But 50 divided by 5 is just 10. That's a simple math. Hence, if I'm using a higher discounting factor, my resulting present value have to be less than those computed on the base of cost of capital, guys. Has to be less. You're discounting it a higher number. Answer A, guys. So those of you said B, is it clear now? Has to be A. It cannot be more. It has to be less. It would be good to have a quick confirmation from those, or everyone rather. I think some of you got it correct. Yeah. Okay, that's why I said it's an interesting question. Very easy, but a slight trick can actually trick you over there. Okay, let's move on to a good practice question as well, guys. We're looking at a practice question where we talk about MTR limited. So while the dinner is being cooked at your homes with some MTR masalas, we are talking about MTR limited question. So it's considering to buy a new machine which would have a useful economic life of 5 years at a cost of 25 lakhs. Scrap value of 3 lakhs with 80%. Now this is interesting. 80% of the cost being payable at the start of the project. So beginning of the project may 80% of 25 lakhs. That means 20 lakhs is payable immediately. 20% at the end of the first year. That's how your project is being funded. Machine would produce 75,000 units per annum of a new product with an estimated selling price of 300. Direct cost would be 285. And annual fixed cost including depreciation, calculated on a straight line basis, would be 840. Okay, guys, what is the depreciation in this case? Can anyone tell me? What would be the depreciation? We are looking at 25 lakhs and depreciation is as per the straight line method or what? Right? So 25 lakhs minus the scrap value 3 lakhs. Economic value is 5. So are we looking at 4,40,000 as depreciation here? Am I correct? Let's see if your answer matches the same. Someone said 5 lakhs. Get 5 lakhs. No, you need to consider the slab. You know, it's a straight line method. So scrap value needs to be considered. So please consider the scrap value. So 4,40,000, I guess. Everyone okay here? That means, can we say cash fixed cost is 4 lakhs? 8.4 minus 4.4, that means 4 lakhs. That's my cash fixed cost. And they've given you one more information that in the first and the second year, special sales promotion expenditure not included in above cost will be incurred 1 lakhs and 1,50,000. So you have outflows in the first and the second year as well. Anyways, the initial investment was split into two, 20 lakhs and 5 lakhs. Apart from that, you have a sales promotion expenses also. And the rate which is given to us is 14%. And we are being told to ignore the tax for this illustration. So that's good news. Some calculation is being saved. But yes, you need to understand if there is a tax, you need to take the tax impact as well. In terms of the expense, it will be a saving. In terms of the revenue, it will be probably a outflow. Now, interestingly, what we need to also factor in here is, in terms of this, we need to calculate what are my relevant cash flows. So how do we calculate that? So let's do some calculation here. Simple one. My selling price is how much? 300. My direct cost is 285. Hence, my contribution here will be 75,000 into 15, guys. Can you guys please confirm that? Are you with me on this? So 75,000 into 15 is 11,25,000. 1125. Now, if tax is to be ignored, do we need to worry about tax shield of the depreciation, guys? If tax is to be ignored, so depreciation tax saving is out of the question, right? So that means we will say less the cash fixed cost of 4 lakhs. That means annual savings from this will be 7,25,000, guys. Can we say that? Annual cash inflows. Guys, I want a quick confirmation. All okay till 7,25,000? Please let me know. If there is any doubt, then also. Let me quickly check the query panel. Okay, thanks for confirmation, Jay and Darshan. I'm assuming everyone also is working around with me. Great. So let's put in all these numbers in a table. Actually, let's put in all these numbers in a table now. So we are looking at year 0, 20 lakhs, and year 1, 5 lakhs. So the initial investment is split into 2 years. 7,25,000 is annual cash flows for every year, guys. And there is a sales promotion special expenditures in the first 2 years, 1 lakhs and 1,50,000 here. And hence we calculate the total cash flows here. Jay, 1 lakh. Now, so we have mentioned that now. We have taken care of that in the table. Yeah, I hope it makes sense. This is what you're talking about. We are taking care of that 1 lakh. Okay, so that 1 lakh and 1,50,000 is being taken care of in year 1 and year 2. So now we calculate the total cash flows. Total cash flows are all the years. Initial year for the year 0, that is initial level or the beginning of the project is 20 lakhs, and the last at the end at the 5th year there is a 3 lakhs of a salvage value also given. So that means my last year's cash flows is 10 lakh 25,000. Third and fourth is 7 lakh 25. And first and second are slightly lesser than 725 because of the initial outflows also and the sales promotion as well. And what we have done is now we are calculating the present value factor of 14%. Generally, it will be given in the examination to you, but in case it is not, you guys can easily use a calculator for this. You just do 1 divided by 1.14. So if you do 1 divided by 1.14, you will get 0.8772. If you press equal to once again, you will get 0.7695. So just keep on pressing equal to and you will get the next discounting factor. It's hardly calculated in 10 seconds. Okay. And then we multiply the cash flows with the present value factors to get along the present value of cash flows. And we do not have to do much except to add these all present values, because I am basically talking about my outflows are in negative here. So you can other way around say that add up these inflows amount and reduce 20 lakhs, reduce the present value of cash outflow. Now in this case, because inflow and outflow is all jumbled up in year 1 and 2, that's why it's better to say that okay, when we add all these present value of cash flows, we are almost getting 3,000 rupees as a positive NPV, 3,050 or so. I'm not worried about if you're getting a slightly different answer for rounding off, that's okay. But as long as you're getting a positive number around about 3,000, you are good to go. You say that, okay, the project may be accepted. All okay? Everyone okay with the MTR thing here? Bhumika, Komal, Said, everyone doing good? Rajiv. Darshan says easy. Very good. Great. Okay, so now we move on to the next discounting technique. Now, mind you, from this point, NPV is not going to leave you. Whether you talk about profitability index, whether you talk about IRR, you will be talking about NPV one way or the other. Now, what is this profitability index? Profitability index is present value of cash inflows upon present value of cash outflows or initial investment. Are you kidding me? Are you kidding me? Are we instead of subtracting, are we dividing here? I think you guys are also seeing the same thing. In NPV, we had a subtraction here. We used to deduct the present value of cash outflows from inflows. Here we are dividing it. That's the only difference. Now, you say why we are doing it? Why NPV is already there? Why profitability index then? Here, we are probably comparing number of proposals which would involve different amounts of cash inflows. And here the decision is not based on positive or negative, but it is based on if the number is greater than 1, accept it. If number is less than 1, reject it. And in case of a mutually exclusive projects, higher profitability index, of course, will anyways be selected. Darshan says what if tax is considered? Darshan, of course, if tax is considered in the last question, MTR, your lot of things will be changed, right? Your 725 will be impacted by the tax. Your depreciation tax saving will be added. Of course, so obviously we will do some practice on the tax related ones as well. Don't worry as of now. Tax will change the entire game here. Okay. So let's see this example on the profitability index. So there are two projects with discounted cash outflows. So we are looking at this example. So outflow is 1 lakh and 1,20,000. These are the two projects. And discounted cash inflows are given as 150 and 190. So if we say the profitability index of project 1 is 150 upon 1 lakhs, 1.5, but for 2 is 1 lakh 90 upon 120. So thus, the project 2 is giving you a higher profitability index. So go ahead with the project 2. So that's an example for a mutually exclusive. So you accept one, reject other. In this case, the advantage, of course, is that you are considering discounting techniques, that is time value of money is being considered. It is slightly better than NPV in the terms that it is a relative measure and not an absolute measure. Absolutely, you're not considering the the amount of initial investment, but here for the different investments you can consider a profitability index, right? So let me give you an example on this actually. So let's say we're talking about project A and project B here. And let's say we talk about initial investment on the top. So let's say this is 1 lakh. And this is 3 lakhs. And let's say the discounted cash flows or present value of the cash inflows is given to us. So let's say this is 390 and this is 150. Now in this case, if you're looking at NPV, we are saying 50,000, 90,000. You're simply going with project B being an absolute measure. But if I am looking at a profitability index here, the profitability index for project A is 1.5, for project B is 1.3. I will say project A here. Are you getting it, guys? Is this clear to everyone? An example which gives you a differentiation between absolute measure and relative measure. So if you're actually considering the relative measure, then obviously the amount of return on the investment is better in the case of project A. But if you're concerned with the absolute amount, then project B. What are your thoughts? Chanchal, Jay, thanks a lot for confirming. Others, I hope this example gives you a good picture. Of course, the disadvantage here is that, of course, you're not helping in any kind of a capital rationing, or you may reject a lower, like in this case, you're rejecting project B, which could be giving you a more in absolute return. So it depends, what as an organization you're looking at. Are you looking at return on investment? Are you looking at more absolute returns? Okay, so that ways you can actually decide which project to be chosen here. Yeah. So let's look at another example, guys, quickly. You can see example on the screen. Now Jeevani Hospital is considering to purchase a machine for medical or projectional radiography, which is priced at 2 lakhs. Now the projected life of the machine is 8 years and has an expected salvage value of 18,000 at the end of the 8th year. Annual operating cost is 22,500. Expected to generate a revenue of 1,20,000 per year for 8 years. And presently you are outsourcing the radiography work to neighbor and is earning a commission, guys. Does this commission give you some alarm bells? It gives me some alarm bells. Does this commission remind you of something, guys? Let me see. Does this actually remind you of something? from what perspective we can consider this commission for? Probably, if you're not outsourcing that work now and you want to purchase that machine for yourself, you will not earn this commission. Can we say this is opportunity cost? This will be an outflow for you. Jay says extra inflow. So Jay, extra inflows currently, but if you consider to bring it in-house rather than outsourcing, you will not be earning that commission. So that 36,000 is a kind of an outflow because there will be a loss of that income. We'll talk about tax also in a while, don't worry. In this question, we are considering tax, but I want everyone to understand that commission here is, see, presently you have outsourced some kind of a function, now you are planning to do it on your own internally. So if you do not outsource, you do not earn the commission income. So that will be lost commission income. Lost commission income is an opportunity cost outflow. Everyone okay here? You need to understand the question also in the right context. So we are talking about a requirement here. Analyze whether it would be profitable for the business to purchase the machine. You have to calculate NPV and profitability index both. Now let's talk about some basic stuff. What are the sales revenue here? We're talking about sales revenue of 1,20,000 and operating cost of 22,500. So what's my margin, gross margin here? So we're talking about a gross margin of 1,20,000 minus 22,500. So I'm looking at probably 97,500 here. And then what's the depreciation? You're looking at 8 years. And the salary value is also given to us. So 2 lakhs minus 18,000 divided by 8. Anyone can give me the depreciation answer? I think I'm getting 22,750. So if I record to calculate the net income, I will do first 97,500 minus 22,750 depreciation. 97,500 minus 22,500. Getting minus 22,750, right? Not 22,500. So we're getting 74,750 here, profit before tax. And then we calculate the tax here. Tax is given to us as 30%. We're getting at 22,425. 74,750 minus 22,425, we are getting a profit after tax of 52,325. And then because we are talking about tax here and because depreciation is something non-cash, we'll add back the depreciation here. 22,750. $75,075. This is what I'm getting. And then we are talking about minus the opportunity cost. Now, opportunity cost is 36,000, guys, but there is a tax also 30%. So should I consider 30%, 36,000 or net of that? What do you think? I think this is already given to us, right? Earning commission income of 36,000 is already told us to be net of tax. So don't do that mistake, right? It's already given net of tax. So we reduce that 36,000 as such because this is already given net of tax. And we are talking about 39,075. We are looking at 39,075. That's my annual cash inflows. I want a quick confirmation if everyone with me on this. So I'm sure everyone is getting 39075. Okay, now let's actually put it all in the table. Let's put it all in the table to calculate the discounted amount, because we need to calculate the NPV and present value, the profitability index. So I think this is the stage where everyone has reached. 39,075 is what we have done. Now, what we need to understand, we get about 8 years, right? So what we're looking at is, so this is basically happening in years 1 to 8, but we can say years 1 to 7, this is the only cash inflow. But in the 8th year, you're also adding a salvage value. So in the 8th year, my cash flow is a little higher. Because what we're doing here is, for years 1 to 7, we are multiplying this with the present value factor. And then this is your present value annuity factor. And for the 8th year, we are using just a present value factor. So there is a difference between a present value factor and an annuity factor, because in annuity, what we do is we add up these rates because it's the same amount. So what we do is we will add these up and we will multiply this with single amount, A into present value annuity factor, and which gives us a total present value of 2,16,832. And we're looking at a positive NPV. That means you're getting a positive NPV of 16,000 plus. Just waiting for everyone to kind of get along with me. I hope everyone is okay. 16,800 is your positive NPV. I think very logical that if I have a positive NPV, that would definitely mean that my profitability index is also going to be more than 1. Am I correct? This is quite logical. If I have a positive NPV, my profitability index is more than 1, guys. And hence this particular machine is probably good to go with. This particular machinery is good to go with. Hospital can actually go ahead with the machine. It's a project that can be accepted. Great. Thanks for confirmation, everyone. Chanchal, Bhumika, Komal, Jay, and Kiran. Great. Okay, guys. So now let's move to the another most important discounting technique, which is probably known to you already to an extent. Did we see this somewhere in the cost of capital? Who remembers this? IRR. Let's see. Let me ask this question to everyone. Who remembers? When did we do this in the cost of capital? Darshan has a very interesting point. Darshan says it's easy, but there could be a probability of careless mistake. Darshan, I'm sitting on a very comfortable chair, but there is a probability the chair can break anytime and I may fall down, right? So there's a probability of everything, my friend. Let's be positive about it. Practice will reduce that probability. Do you agree with me? Practice will reduce that probability. Okay, so Darshan says YTM method. Perfect. So we talk about YTM method, right? In case of debentures. That's where we studied that. The IRR. I showed you that formula as well earlier. Okay, so let's talk about this IRR again though. So case internal rate of return for an investment is that discount rate at which the present value of the expected cash inflows equal to the present value of cash outflows. Can we say that your IRR is that rate at which NPV is 0? Can we say that? Because we are saying it's that rate at which present value of your expected cash inflows equals the present value of cash outflows. That means NPV is 0 at this rate. And for the decision making, we compare this with organizational's desired rate of return. I will tell you the logic also behind this, guys. Why do we say this? We'll talk about some logic also on this case. Why do we evaluate basically on such grounds? Now, first of all, I would like to talk about calculation of IRR. And again, we are discussing two possible scenarios. One, wherein we may have a uniform cash flows. Uniform cash flow means like same cash inflows every year. And in that case, like we discussed in the payback method also, right? Now, in that case, we are looking at a present value of cash inflow is equal to the present value of cash outflow at IRR. That is very okay. But what does that mean? If I want to expand this equation, can we say present value of cash inflows in case of uniform cash flows is multiple or product of present value annuity factor and the cash flows, guys? We are expanding that equation, by the way. We are doing nothing else. That will be equal to your initial investment. And hence, in this case, if I know that my annual cash inflows are uniform, I have an initial investment. So initial investment divided by the annual cash inflow, we will actually get the present value annuity factor. We'll get the present value annuity factor. In that case, if we check the annuity table, whatever annuity factor we are getting for a particular period for which the project is related to, we are basically selecting that rate as a IRR. Guys, I hope everyone is getting me on this. Everyone okay? If we are calculating the present value annuity factor based on this formula, and we check the annuity table, and with respect to a particular period, we are actually getting it that, okay, this is my IRR rate. This is what my IRR looks like. So just give me a quick second. Let me show you something. Just for your understanding. Let me show you something. I'm just showing you an abstract here, which will help you to evaluate that, okay, what are we even saying here? Okay, let's say this. Quick second. Let me know once you can see the abstract here, which I want to share. I'm sure now you should be able to see it. Guys, I hope you can see an abstract here of our annuity table, which is the present value factor. Now let's say, let me talk about a very weird thing, or in terms of an example. Let's say that present value of my cash inflows for a project which is having a life of 6 years. 6 years. Let's say This is 14 lakhs 86,900. We're taking an example, weird example. And let's say initial investment is 3 lakhs. Now, if I were to say that it was a uniform cash flows, what would have happened is your present value annuity factor into cash inflows would have been or rather equal to the initial investment because NPV is 0 and IRR. Hence, we will say present value annuity factor would be what it would be, guys, in this case. Any idea? Okay, I think you need to just add one more zero probably. Just give me a second. Let me just change this amount for you guys. Just changing one amount for you guys. So that you guys can make a sync on this. Let's say my initial investment is actually not 3 lakhs, but rather 63 lakhs. Okay. Just adding one digit over here, 63 lakhs. Now, in this case, what would my present annuity factor will be? Initial investment upon the present value of cash inflows. That means 63 lakhs. Guys, everyone with me, whatever we are discussing here. We are talking about initial investment upon the annual cash investments. And that's what will be giving us the amount in terms of, okay, Darshan says 4.623. Darshan, how did you calculate that already? How did you calculate that already? I told you the present value of cash inflow for a project, right? But we are not even talking about the cash inflows right now. That is something I need to tell you in addition, right? To compute this formula. So what we need to do is divide it by the cash inflows. That will give you the present value and annuity factor, right? Am I correct, guys? Can you please confirm? We are talking about initial investment upon annual cash inflows here to calculate this. So let's say my cash flows are that I can tell you now, just for your understanding. Let's say my cash flows are, which is undiscounted, which is 2,27,000. Now, can anyone tell me what is the amount in that case? If we're talking about, okay, 2,27,000 upon 63 lakhs divided by or rather 22,72,000, how much it should be? Can anyone tell me? We're talking about 63 lakhs here, right? 63 lakhs. We're talking about 2,27,000 would be too much, 30. So let's change this number. I want to make it more realistic because we're talking about 6 years. So what can be a number within 6 years? We're looking at a cash inflow of 63, cash outflow of 63 lakhs. 6 years, let's say something like 14 lakhs, 15 lakhs, because we are talking about NPV 0, guys. So let's take an example where my cash inflow every year is 13 lakhs 86,000, the same amount which we talked about, just that we are talking about cash inflows, not the present value. So let's take a rounded off number here, 13 lakh 86,000. So what is that amount? 63 lakhs divided by 13 lakh 86,000. We're getting a 4 point, I think Jay already answered that, 4.545. We're talking about 4.545. Right? So we are just taking a simplified example, just that everyone is clear on this. 13,86,000 is divided, or other 63 lakhs is divided by 13,86,000. We're getting 4.545. Bhumika, I just added a digit here because that was giving a weird number. I know you calculate using only 3 lakhs. So I just changed that amount. I hope it is okay. I'm just explaining you how to calculate looking at the annuity table. Thanks, Bhumika. Others are okay. Jay, Komal, everyone doing good? Chanchal. Now, if I look at this annuity table, guys, where do this 4.545 we find? 4.545. I can see 4.545 is right somewhere in this 6th row, right somewhere in these two rates, right? 4.623 and 4.486. That means it is probably between 8 and 9. It is probably between 8 and 9%. Remember my cost of capital discussion, guys, at that time. So that means if we are looking at this from a perspective of that we have to calculate present value annuity factor, looking at the annuity table, we are stuck, right? 8 or 9%. Jay says 4%. How come 4%? We're talking about 6 years, right? Guys, can you double check? Should be 4 or between 8 or 9? I think it looks to be between 8 or 9, I guess. Now, how do we calculate this? For this, we learned this formula at cost of capital in YTM method. We'll say that IRR shall be the rate that corresponds to the annuity factor, along the row for number of periods. Now, if my annuity factor was matching, actually, let's say if my annuity factor was matching exactly 4.623, I would have said 8%. But I'm not getting 4.623, I'm getting 4.54. So that means I have to apply that formula which we discussed earlier. It doesn't match, it falls between the two rates. The IRR shall be using the formula which we used by for calculating the YTM method. So your IRR formula, guys, you need to know this, is lower rate plus NPV at lower rate upon NPV at lower minus higher, multiply the difference. You need to understand that we are talking about two NPVs at lower rate and higher rate. And generally a higher rate NPV would be a negative NPV. So your denominator will actually be resulting in a, let's say A minus B. So minus B will be plus. Make sure that you understand this. Minus in the denominator will become plus always. Now, I have a question to everyone. Guys, even if we do not have a uniform cash flows, even if we don't have a uniform cash flows, what will we do? Even if we have a uneven cash flows, in that case, we can take a random rate by ourselves. If we are talking about uneven cash flows, in that case, we'll discount the cash flows with any random rate like 10, 12, 6, 8, whatever. What we need to understand is we will be needing two NPVs for calculation of IRR. One, we need positive NPV, and one, we need a negative NPV. So I asked this question earlier also, but let me repeat this one. Let's take an example that at the rate of 10%, we get positive NPV. Now, what should be my other rate to get a negative NPV? Should be higher than 10% or lower than 10%? Should it be higher than 10% or lower than 10%? I need some answers here. Let's see what everyone has to say. And if everyone is uniformly saying higher than 10%, of course, because we have to divide it by a higher number to bring the inflows lesser. So let's say the other number we take 14% for a -1. It has to be higher than 10%. It could be anything. And then we have to use the same formula. Because my NPV now will be in the middle of the two rates. Guys, I would like to talk about for 2 minutes for my acceptance rule with IRR. When we started IRR, mind you, I told you that we compare with WACC or cutoff rate. If IRR is more than WACC, we accept the project. If IRR is less than WACC, we reject the project. But what is the logic? Look at the logic here, guys. If let's say my WACC is 8% and my IRR is 10%. Guys, do you agree if NPV at the rate of 10% is 0, NPV at the rate of 8% will be positive? Do you agree on this? We just discussed this. Can you please tell me if you agree on this point? If my IRR is 10%, my NPV is 0, right? I said my WACC is 8%. So if I have to calculate NPV at 8%, I will get a positive NPV. Yes or no? That means we are good to go. In NPV, we learned this, right? In NPV, we learned this. If NPV is positive, accept the project. Question says yes. What about others? Bhumika, Jay, perfect. That means you understand the logic now. Think it other way around. If my IRR is less than WCC, let's take another example. Let's say my IRR is 7%. My WACC is 9%. Now in this case, we are saying that okay, IRR is the rate where NPV is 0. So if I have to calculate the NPV at higher rate, it will be negative. Negative means reject the project. I hope everyone understood the logic behind this. I hope everyone good to go here. Now let's quickly have a look at a scenario, an example, wherein we are looking at a uniform cash flow. So Zebra Limited is evaluating a project with outlay of 10 lakhs, resulting in an annual cash inflow of 2,50,000 for 6 years. So 10 lakh divided by 2,50,000 is 4. The example I gave you already. And we say that, okay, 4 is looking at the annuity table is coming out to between 12 and 13%. But I can see at 13%, it is very, very almost close to 4, right? That means my IRR is somewhere more than 12.9%. It is closer to 13% in this case. Because I'm getting present value annuity factor as 4. 4 is more to 13% than more closer to 12. It is definitely more closer to 13%. So what we do is, we will use these two factors to calculate two NPVs. NPV at 12%, we're getting positive. NPV at 13%, very logically we're getting negative. And when we apply this formula, we get 12.98% as anticipated, guys. As anticipated, we get a 12.98. As I said, it was looking to be almost closer to 13%. I hope everyone good here. I hope everyone doing good. Okay, let's look at one more illustration quickly. A company proposes to install a machine involving a capital cost of 3,60,000. Lifetime or the lifespan of the machinery is 5 years. Salvage value is nil. Machine will produce a net operating income after depreciation of 68,000. Company's tax rate is 45%. They've given you the net present value factors for 5 years with different rates, 14, 15, 16, 17, 18. So first we have to calculate my annual cash inflows, guys. Annual cash inflows we have given after depreciation of 68,000. So we will subtract the tax first, and then we will be add back the depreciation because it is non-cash. 3,60,000 divided by 5, 72,000 is added. So my cash inflows become 1,09,400, guys. Yes, Bhumika, 10%, 13% was as per the table. Those are as per the table. Okay, so guys, everyone okay to calculate the cash inflows? I'll be just needing 5-7 minutes more, guys. We are done with it. Just be with me for 5-7 minutes extra. We'll wrap it up in 7 minutes. Okay. So 109,500 is what I'm getting here. Hence, we can calculate now the present value annuity factor. So my initial investment is 3,60,000. We divided by 1,09,400, we get 3.29. We get 3.29. Again, let's go back to the annuity table. Now, for 5 years, I can see 3.29 is somewhere between these two, 15 and 16. Somewhere between these two, 15 and 16 years, 3.29. Hence, we need to calculate the NPV for 15% and 16%. 15% pay we get a positive NPV. 16% pay, you guys can do this calculations later on. At 16%, we are getting this as a negative NPV. Getting a negative NPV. So we apply the formula and we get 15.74. So please do some practice how to apply this formula. We already did that at the time of YTM. But now we are almost, kind of repeating the same exercise so that everyone is clear on the same. Okay, guys. So last particular, kind of a brain teaser for everyone here before we call it off for the day. This is the last question for the day, guys. I want you guys to give your best shot. You guys can take a minute. So let's see what's the answer for this. I'm getting some different answers. Some people are saying D. Some people are saying C. This is a very, very interesting question. Trust me. Some people are saying A also. Bhumika, interesting. Okay, so I think different answers. Let me walk you through this question quickly, guys. The question's call is which of the following would decrease the IRR of the proposed asset purchase? Now, this question is a classic example where you need to remember a concept called ceteris paribus, other things being constant. We will evaluate each option on its merit, guys. But first of all, how the IRR is calculated? IRR is calculated is by basically multiplying the cash flows, discounting them. We calculate this. We subtract the initial investment and we say that it is 0. Guys, everyone with me on this? Because in this case, in this question, we are getting A, B, C, D, all the 4 answers. But everyone okay, how to calculate IRR? IRR is that rate at which the NPV is 0. IRR is that rate at which NPV is 0. Now, if we look at the fourth option, use the written down method instead of straight line method of depreciation. In that case, my depreciation in initial years will be high. Hence, my tax shield will be high, tax saving will be high. My tax shield will be high, guys. Now, if my cash flows will go up, cash inflows will go up, and initial investment remains same, for the NPV to be zero, my rate will go up, guys. Because of the tax saving, my cash flow is going up. Initial investment is not changing. That means for NPV to be zero, my rate has to go up, and hence option D cannot be the right answer. Very interesting perspective. Cash flows are increasing because my depreciation tax saving is increasing. Initial investment may no change. Hence, to keep NPV at zero, because that is what my IRR is, my rate has to go up. This is gone. Shorten the payback period will also mean higher cash inflows in earlier years. For this also, I would say the same reason as D. If I have to increase my cash inflows in the earlier years, my rate has to go up. Option C also gone. So it has to be A or B, guys. A versus B. I hope everyone okay. Why not C and D? C and D are not right answers based on the same logic. So Bhumika, Chanchal, Syed, everyone doing good? Now let's look at option number B. Option B says decrease the working capital requirement. Working capital means my initial investment will go down, right? So my cash flows are same. My cash flows are same, but my initial investment is going down. If that is the case, my NPV will start becoming positive, but will has to be zero, right? And for making it zero, my present value of cash inflow has to be down, has to be reduced. And because of this, my rate will go up. Because see, other things being constant, if my initial investment is going down, my cash flows remain the same. I have to increase the rate. I have to increase the rate. Hence, guys, option number B also gone here. We are left with only A. Decrease tax credit. Now, how come that is the correct answer then? Let me quickly tell you this. That is a very, very interesting question. A question which deserves a good round of discussion and a perfect question to end the class also. We should always end the class on a higher note so that you guys can go back, introspect, study that topic, right? So what's happening? Decrease tax credits. What is tax credit, guys? Can we say it is a reduced subsidy? So government has given some kind of a benefit on the machinery. If that subsidy is reduced, that means my initial investment will go up. So what is happening is present value of my cash inflows minus initial investment has to be zero. Now that means if my initial investment is going up, my present value of cash inflow also have to be go up. This means my present value of cash inflow also have to be go up for NPV to be zero. And now cash inflow there is no change. Hence, my rate has to go down. My rate has to go down. That is why option number A, folks. Option number 8 is. Darshan says this one is really interesting. Darshan, I agree with you. But I don't know what others. What Bhumika says, what Jay says, what Chanchal has to say on this. What about others, guys? Some people have been Rajiv, Syed. I'm sure everyone liked the question. This is perfect question to have a good understanding on IRR. Okay, guys, so I think time for us to break a halt here. I request everyone to go back. We have actually virtually studied almost all the discounted and non-discounted techniques, including the discounted payback. But what we will do is we'll resume on Monday on talking about the comparison between NPV and IRR. We will also talk about something called modified internal rate of return. And after that, we will be going ahead with a lot of practice, guys. A lot of practice will be done. So make sure that you guys are kind of coming up with the definitely a lot of study behind you, as in like whatever the techniques we have done. So we have a longer session on Monday. Probably will have to be on our toes. So it will be really helpful if you guys can come up with some study. Do some self study and do some practice. Also, make sure that you are comfortable with all these methods. We'll talk about some NPV and IRR in comparison. We'll talk about MIRR, and then we'll be doing some practice towards the end of that session. And don't worry, I will be giving you at least 2 or 3 questions as a homework also for NPV and IRR calculations. And after Monday session, I will upload another file which will have solutions for those questions as well. So thanks everyone for staying back, and I'm sure you guys enjoyed the session. I really did, pretty much with respect to your involvement and your constant interaction that keeps the session going. So let's see you all on Monday, guys, and we continue and wrap up investment decisions as well. So take care, be safe, happy learning, keep on the good work, make sure that we are all safe. Best of luck. Cheers and good night.